Today what we're going to be discussing is how to refinance your current home and or your existing mortgage if it makes sense for you. So why don't we get right into it here for you. And we're going to just get to the next slide. So why refinance your existing mortgage? Well, your home, of course, is your largest single asset, and it can be a very powerful financial tool for you. And one of the things is it may or may not be good for you to refinance, but as you build up equity over time in your home, you do have much sort of options to assist you in borrowing options to meet your financial needs. There's different reasons that everyone's going to do for refinancing. And Canadians typically refinance their property for three major reasons that we found over our years of experience. Number one, of course, they want to save money on their existing mortgage. And especially now when we're at historic low interest rates, of all time, basically a lot of people are looking at how can I lower my interest rate and how can I pay more interest to the bank and pay more principal directly off my mortgage. The second one is to consolidate high interest rate debt. And that's a very key component, again, is the ability that if you have a lot of consumer debt and equity in your home, there may be a way to get a better financial structure for you, so that way you can look at getting a better financial plan of how to save money and pay less interest costs for you. The third one is to access funds for home renovations, investments, children's education, purchase of additional property, or business expenses. And that may be not more than number three reasons, but that is definitely, there's a lot of various reasons to take funds out of the home for different purposes. So, when is the best time to refinance? Obviously, as we talked before, right now is a fantastic time. If you have any interest rate mortgages, say over 3% at all, you should definitely take a look at what your mortgage options are and including what your penalties are, because there is a great time at where the interest rates are right now. The other reason is if there's savings to be had at all, as we talked about before, if you need to access the equity in your home is another good reason. And when your mortgage is up for renewal, and you should be looking at least 120 days out from when your date of your renewal is, so that way you can shop around for various mortgage options. What is equity? Equity is the difference between what your home is worth or appraised or what your current mortgage is. So it's the difference between those two numbers. And that is what we call the equity. Now, there have been government rule changes as of late, and you, the consumer, are only allowed to refinance to a maximum of 80% of the value of your property, and that is dictated by the government. So if your home is worth up to $200,000 as an example, you can only finance up to 80% of that. The equity can fluctuate, of course, based on current market value of your home, and if your home has increased in value, you may have more equity than you expect. To do that, what they're going to possibly send out is potentially an independent appraisal, and that way an independent third-party appraisal company would actually be able to assess what the value of your home is worth. And if your home is worth less, unfortunately that will lower the amount of equity you could potentially take out of your home. Refinancing for a better interest rate. This is a key component about why most Canadians do refinance, and it's really to save money. And what it is basically looking at how do I pay less interest to the bank and pay more principal down. After all, as we as Canadians, our home is a tax-free savings investment, so it's very important to pay down the principal as fast as you can. So how long do you plan to be in your home? It's a very good question. If it is 5 years or longer, it may make sense to refinance to save an overall interest cost and be able to pay down your mortgage sooner. And then there's prepayment penalties. Every lender does charge a penalty if you pay your mortgage off early. The amount can vary, but the standard rule is it's 3 months interest or interest rate differential, which is interest rate differential is the spread between your current rate and the rate left for the remaining time on the mortgage term. If you can refinance on your maturity date, there is no penalty. So once again, if your mortgage is up for renewal and you want to refinance on that date, there would be no penalty for you at all. The cost of a new mortgage. Whenever you take out a new mortgage, there are a number of costs associated with it, and there's appraisal fees, which may or may not apply. There's definitely going to be a penalty if you're an existing mortgage. Now, of course, again, there are reasons why there may not be a penalty, as we discussed before. And then you do have legal costs to re-register the mortgage. So there is legal fees to re-register it. You need to know, of course, what we always try to do is make sure all your costs are associated to you up front That way you can make the best informed decision of whether you want to break your current contract or not. And again, some of these costs may be partially covered by the lender who's going to take on your new mortgage. So we do definitely work with lenders who have the ability to help you cover some of the costs. So how do you calculate the break-even point for you? What we suggest is, what are your monthly savings over the mortgage term? And we can all do this for you at Dreyer Group. We can calculate what your monthly savings are going to be. What will be your total interest savings over the length of the term. We'll calculate that for you. And, of course, what will your mortgage balance be on maturity? And we can give you a spreadsheet to compare that with your existing mortgage to what the new mortgage rate and terms are going to be. So that way you can make a very informed choice if this is something you'd like to proceed with. Refinancing to consolidate debt. Refinancing your debts into your mortgages is not a strategy that's suitable for everyone, of course not, and of course it depends on your own personal situation. So what you want to consider when you're consolidating debt is, how much money is going out monthly to pay down your debts. So if there's a large chunk, if it's over anywhere from, $400 to $1,200 a month in outside debt, you should be taking a look at it. And I think the key thing here is how long will it take off to pay your consumer debt based on interest rate charges. And what we look at with a lot of our clients is we only say that if you don't have the ability to pay it down, or you've been saying for 3 years you've been in that line of credit and the balance just is not going down, it makes sense at that point in time to do those types of things. Or same with your credit cards. If your credit cards are on high interest rates because they're all at around 19%, or even if you can get low discounts for 10 or 11%, it's much better off when you're paying below 3% for your money that you take a look at how you can refinance the property for yourself. Any consolidation loans over $25,000 are not likely to be done without security, such as a car or an RV rental or anything of that nature. And of course, those rates can fluctuate anywhere between 8 to 14%, depending on what type of financing company you've used. So it definitely makes sense to look at any of those long-term debts for you. Could you reapply those monthly savings back into your mortgage by increasing your mortgage payments? Absolutely, and that's what our advice is that if you refinance your mortgage and you decrease your payments by, say, $500 a month, what we recommend is increasing that mortgage payment now by $500 a month, and that way you're paying down more principal right off the bat and less interest costs for you, and it helps you to save more money in the equity in your home. Here's an example of a great scenario chart, and this is just example purposes only, of showing you if you had a current mortgage of $200,000, and we'll look on the left-hand side of the column. So it's at 4.5%. You had a car loan at 8% at 19.5, department store credit card at 4,500, unsecured line at 7,500, a Visa at 6,500, and then you had a penalty to break your mortgage of 3,000. So that totals $241,000. Now, if we look on the right-hand side of the column, we take that balance of $241,000. We do it at a new interest rate of 2.99%. Your monthly payment's $1,139.29. You paid off the auto loan, the department store credit card, you paid off the line of credit, you paid off the Visa card, and you paid off the penalty to break the mortgage. So what you've been able to do is you've reduced your payment from original all payments combined of $2,076.35 to a new payment of $1,139.29. So you've reduced your monthly payment and outflow by a considerable amount. And now with that extra money that you saved on a monthly basis, you can do a couple of different things with it. One is you can increase your payments if you want to a higher amount to pay off your principal faster, or set up an RSP plan or an RESP plan for yourself, so that way you can start saving money and building your financial net worth. So, as we talked about, the monthly savings, of course, as we said, was there for you. And, of course, we already talked about increasing your mortgage payment or making lump sum payments to your mortgage. It will reduce your overall mortgage interest costs and pay down your mortgage much quicker for yourself. So it's a very good scenario to look at as an example of why you should refinance. Refinancing products. There are different products available for your refinancing needs, such as a fixed-rate mortgage, a variable rate mortgage, a home equity line of credit, or a combination of the above to keep your finances separated based on your borrowing situation. And that means we do have flexibility where we have products that will allow you to go fixed rate plus a line of credit or variable rate plus a line of credit if you want those type of options for you. So those are available and something that is on an individual basis decision. What do you need to refinance? You need confirmation, of course, of your stable employment income. You need a good credit history. We do need to make sure what your property is worth, and most times it is an independent third-party appraisal that does that. We do need a copy of your current mortgage statement to show how much equity you potentially have in the home, a copy of your current house insurance, and if you have strata property, they do require a little bit more information, which we can get into detail with you once we start an application. Employment, if we go through each one of the topics here for you, employment, we do need at least 3 years of stable employment or income, or at least in the same field. And how lenders confirm employment, they do it through the various tactics here, which are job letters, which state how long you've been there, your position, and rate of pay. They will also ask for a recent pay stub, and sometimes they will ask for Revenue Canada notice of assessment if overtime or bonus income is included. And most lenders will also, of course, call the job letter to confirm the details of the employment. So it's always good when you get a letter of employment, who's ever written that letter, it's nice to give that person a heads up that somebody will be calling to verify that information. And what that does will help speed up the process of a mortgage approval for yourself. An appraisal, we talked about that quite a bit already, but it is what lenders use as a third-party person to go out. And that third-party person goes out, looks at the home, compares it with 4 different homes in the area for resale, and will basically come out with a value for it. The cost of an appraisal is approximately $250 to $300, and that is borne by you, the consumer. Home or fire insurance, we do need to get a copy of fire insurance. Lenders do require all homes have fire insurance on a detached single-family home with loss payable to the lending institution. Legal fees. Legal fees generally range between $750 to $850 to convey, title, and register a mortgage. These figures include fees, disbursements, GST, and TST. Title insurance, of course, may also be required, which may cost between $150 to $250 depending on the property. What title insurance does, it helps protect the lender if anyone registers any fraudulent activity against the property or any easements or right-of-ways, and definitely the lawyer and notary can advise you on better about the title insurance. Some lenders, of course, do offer reduced legal fee packages for yourself as well. So that comes to the end of our session here, and if you would like to, of course, get a full 2014 Home Buyers Guide, please email us at clientservices@dreyergroup.ca, and once again, it's clientservices@dreyergroup.ca. And we do have time right now. If you have any questions, if you want to type them into the chat box section there, basically we can answer any questions that you had regarding our presentation today, and we'd be happy to take that for you. So if you just want to type in any questions in the chat box, we're available to help you out. And I would just like to, of course, thank you for attending who's been on there today. And I really appreciate you taking the time to do that for you. Great. If there are any questions at all? Excellent. Thank you. How long is the typical process to refinance a mortgage through the bank versus through you? Great question. And how it is, it can take, through ourselves, we can usually get it done within 24 to 48 hours. Through the financial institutions, they're usually about 3 to 5 business days. So we're much quicker because we have direct access right to the financial institution. So we don't have to go through anyone who has to approve the deal, whereas if you're going into the branches, they have to take it up through different levels and channels to do that. So we deal directly with that. So it's a great question that way. Next another question. If I decide to renew my mortgage with my existing bank, would I have to pay legal fees and appraisal fees? No, you do not. Well, sometimes you will, yes. It depends if you do. A good question about that is that if you're renewing your existing mortgage and all terms and conditions remain the same, there are no legal fees or appraisal fees. And I can say that the same through us. If we are transferring your mortgage and everything stays the same, we don't make any changes, and we transfer it from TD to Scotiabank, there is no cost for you whatsoever. The new lender that you're transferring your mortgage into will pick up all legal fees, all appraisal fees. It's only if you refinance, and by refinancing, what we mean is you change the term, the size of the mortgage, or you change the amortization period of the mortgage. As soon as you do that, then the mortgage has to be re-registered at Land Title's office. And next question is about the time to consolidate. Consolidation, again, we're much quicker and faster about getting consolidation of your debts and mortgage done to you. The reason, again, is simply that is because we know what we're doing. We are professionals in our field, and we're not trying to cross-reference with you, of course, with selling you, checking your savings account or an RSP plan on top of that. So we're strictly doing our mortgages to help you out and be professionals. We can get it done much quicker for you. Great. Is there any other questions? If not, then I'm just going to say, as an alumni, we are very happy to offer benefits such as a guaranteed best rate up to 1% off the bank posted rates. We do offer free appraisals, and we do offer a free legal fee credit to all alumni. Plus, a portion of every mortgage goes back to helping future graduates and alumni services and programs. If you'd like us to reserve your best mortgage rate and lock that in for 120 days after this presentation is over, or if you would like to speak to us, you'll be automatically be directed to a 30-second quick application. Complete that, and one of our mortgage professionals will contact you shortly. I'd like to thank everyone again for coming, and I really hope you've enjoyed this session. Thank you very much.